You're listening to The Intellectual Investor, episode number 96, Investing for Beginners interview, part 2. To learn more about Vitaliy's investing firm, IMA, go to imausa.com. Investing for Beginners interview, part 2. It was a pleasure to talk to Andrew Sather and Dave Ahern on the Investing for Beginners podcast. In part 2 of a two-part series, we take a deep dive into Uber as a value investment, the competitive threat from Tesla and self-driving cars, and the capital expenditure required to justify Tesla's valuation. Enjoy.
All right, so maybe we should pivot off of politics and let's talk about Uber. So you had a great series that you wrote about your thoughts about Uber, and I would love to hear some more ideas on about that company.
Well, so I just to listeners, I just want to tell them, and I'm going to be a little self-promotional, but not for the for the right reasons. I'm so much smarter on paper than I'm in person. So if this conversation on Uber piques your interest, I do have this 13-page in-depth write-up on Uber that you can just download for free on my website. Just because I go into that in so much depth, but just to sum it up, it's like probably one of the most controversial stocks we ever owned, because we are value investors, right? And we are buying this company that never made any money, that I think lost $5 billion last year or something like that, that has a contentious relationship with its drivers. Politicians hate it. Everybody hates it. And at the same time, we think it's a great investment, and I think the most importantly, people who use it love it, right? And which to me is maybe more important than politicians loving it. But I think I think Uber is misunderstood, and I say that because I kind of look at how my thinking about Uber evolved, and I think I used to be in the same camp as everybody else, like everything I just told you, this company is losing money, et cetera, et cetera, et cetera. If you look at and it's digital competitors, let's say that you look at Facebook. When Facebook, the faster Facebook was growing, the more money it was making. And what I mean by this, it's not like if it grew earnings, revenues 100%, its earnings would go up 500% or something like that. And the reason that happened because technology companies have a substantial economies of scale, right? For Facebook to, let's say Facebook wants to go into France, for them to capture French market, their incremental costs are de minimis, because they just have to translate their website to French. That's it. And maybe install some data, kind of buy more capacity of, data, kind of build out data service in France or something, which doesn't cost that much. Costs millions of dollars, and then they have billions of dollars revenues. Now, Uber is kind of a hybrid company. Part of them is like a digital company like Facebook, which is basically a switchboard between a passenger and a driver, right? If you think about it, when you take Uber, the cost to Uber of that of that ride is de minimis, right? Because all they're doing is just connecting you to the driver. Okay, so but the problem is, there is a second part to Uber business, which is analog. And what I mean by this is more like a brick and mortar kind of more or less part of the business, where in the past, when they were growing, they would go into new market. Let's say they go to Australia. They come to Australia at that point in time, they have zero presence there. So, and it's a two-sided marketplace. So, for riders to, so what they had to do, literally, they had to pay drivers for months and months to sit and do nothing. Because then, once they had a kind of driver sitting there and waiting for the passengers to come, they had to go to passengers and say, by the way, you can take Uber now. And so, can you imagine how much it costed them to create the two-sided marketplace? It was enormous cost. So, and then every time it would go to new town, etc., the taxi, they had to fight against taxis because, taxis were local monopolies and they obviously did not want them to come. So they had a huge legal cost. In addition to that, they had to, spend a huge amount of money in R&D, build out new products, all the, create accounting systems, etc., all these different things. So it took them a while to get to scale on the analog side of the business. And my argument would be last year was the year when they got to scale on that side of the business. And if you just look at Uber Rides business, not the other businesses, that business was actually cash flow positive. And if COVID did not happen, the whole company would have been more or less cash flow positive by the end of the year. And then, and this is where the interesting part happens, as the Uber, I would argue that Uber Rides business, is still in the infancy, because it's not competing against taxis and rental cars, though it does, but that's not the core market. The core market is a car ownership or taking ride. Actually, not even car ownership. It's you taking rides, which could be cars, which could be taxis, could be rental cars, but it also could mean that you're taking subway or bus. So the market for them is absolutely enormous, and they do have a significant competitive advantage because they're the largest. And in this market, being the largest actually gives you a huge competitive advantage. And therefore, they are most likely to be the company to, when the market matures, they would capture the largest portion of the market, and therefore the economics would accrue to them. And also, here's the key. Once the analog business is at scale, the digital business basically is responsible for incremental profitability, and it's incredibly profitable. So the contribution mark for every dollar of incremental sales, 50 to 60 cents should drop to the bottom line. So therefore, when we were buying Uber, if you look backwards, it looked insanely expensive because it lost money. But what we see, if you look 3 to 5 years out, we see a company could actually make at least $3 of earnings per share. So suddenly, it didn't look as expensive to us when we were buying it.
So can I chime in here? I don't want to get too deep into the accounting and stuff like that, but am I correct in assuming that essentially they had negative operating cash flows, but you're saying those were towards building the analog side, and those expenses that were on the operating side are not going to be there in the future because they have the analog side built up?
Yes, and actually just to make it clear, that's part of the story. Because Uber is actually, when we just say Uber, we assume it's one business, but there are multiple businesses inside of it. So the rideshare business, that's by far the largest business and the most profitable business. But there is another business that's suddenly exploded over the last 4 months, which is Uber Eats business, right? And that business is still losing a lot of money. So when we were analyzing Uber, we basically had to make an assumption that one of the two things will happen in the next 5 years. Either Uber Eats turns cash flow positive, or they close it. Okay, because it's not right. If 5 years is plenty of time for them to figure out if this business, has a reason to exist. Because unlike Uber, unlike their core business, this business, the Uber Eats business, is more difficult. And the reason it's difficult because in addition to having three parties involved, which is a passenger, driver, and Uber, you also have a restaurant in the middle. And therefore, it's more difficult to make money because you have less dollars to divide, between all these four parties. So for that business to succeed, they basically should be able, they need to be able to batch orders. So when the driver comes to Chipotle to pick up a order, he needs to pick up 2 or 3 orders and drop them off to customers that are right next to each other. if otherwise those breweries will be cold. And also the ticket size has to get larger. So if they get there, and unless and that's an assumption, if then this business will be worth a lot of will be worth something. And if they don't, then they'll shut it down. And that's how we looked at that. That's how we looked at that.
That makes a lot of sense.
Yes, it does. So I guess a question along those lines then, when you're talking about looking at the different businesses, how do you go about valuing something like that? And that's one of the things that I struggle with as a value investor is all the things you were talking about, I see the negative cash flows, I see the negative earnings, losing money, all those kinds of things. And I think, whoa, I'm not touching this with a 10-foot pole. So how do you step past that to look at a company like an Uber?
Well, so first of all, I think I'll give you two answers to that. Number one, so when we are analyzing Uber, we had to understand, we actually analyzed each business inside of it independently. Okay, so just looking at the income, looking at the income statement overall, combined company and cash flows is not very helpful. So you really have to look at the economics of each business. That's point number one. And so once we understood economics of each business, we realized that you start understanding the analog side and digital side of the Uber ride business, then it becomes easier to see that they're now entering this into the stage where the digital business now runs becomes more important. That's point number one. Point number two, it's also important to understand how, if you look at Googles and Facebooks of the world and kind of analyze them in the hindsight, you study these businesses and see what happened to them, it helps you, gives you some clarity to understand how these businesses evolve over time, how they have a fixed costs, right? And this fixed cost is, over time, the revenue growth, the cost starts growing at a slower rate than revenues, and the margins expand. And suddenly, 15% revenue growth translates to 30 or 50% earnings growth. So it's right. So I would study I would study the other companies, and that's what we did. We spent a lot of time looking at Priceline.com and other companies, to see how they evolved.
That makes sense. So I guess kind of along those lines then, what do you see as a potential, I guess, risk or, I guess, disruptor of your idea of Uber and their move towards profitability? Is the the evolution of driverless vehicles? I know that's probably a little bit out, but is that something that is a concern for Uber, and your thoughts on that part of what could happen?
All right. So I'll do another shameless self-promotion, but again, it's for the benefit of your listeners. Okay. I wrote a 35. When I get into this project, I really go very deep. I literally wrote a 35-page write-up on Tesla. And because I bought the car and I was so blown away by the car that, I started, I realized that's kind of the future, and I started the whole industry. And I wrote this 35-page write-up. Again, go to contrarianedge.com. You can download it. It's free. Just I'm getting nothing out of that. Just, the satisfaction that your listeners read my, 35-page write-up. Or they can listen, by the way, they can listen to it on my podcast. It's all there. So by the way, both Uber and Tesla pieces are there. But anyway, the reason I'm bringing this up, so when we were studying Tesla, one of the big questions for me was, what's the future of self-driving? And what I realized that this self-driving is so much further away than people, than Elon Musk would make you believe. And the reason for that, it's a lot more difficult. Well, there are a couple of reasons. Number one, it has to be perfect. It has to be nearly flawless, and it has to be. And it's not that it's not what the car does on a shiny day on the highway when you have clear dividers. It's what happens in this kind of unique circumstances where there is a cone suddenly lying in the middle of the lane, or there was a construction, or I saw a video, I saw a video of a guy walking along the highway with a stop sign, carrying a stop sign behind him. Like, what do you do like when that happens, right? So,
right.
It's so that's number one. So you have to the cars have to be trained for all this like very rare events. Okay, that's number one. Number two, we don't have a legal framework for that yet. Like, so what happens? Who's responsible when a self-driving car, causes an accident or is an accident? We don't have a legal framework for that. So the point I'm trying to make is that self-driving is probably good 10 years away. Okay, it's gonna happen, but it's just most likely what's gonna happen is we're gonna have the self-driving is gonna be more like assisted driving. And let me give you this analogy for you. Radiologists, right? They read X-ray, and normal radiologists can probably read about 100 X-rays a day, more or less. Now, computers, if you think about it, especially if you have a specialized in a certain area, computers can actually probably do as good of a job reading X-rays or better than humans can. But the problem is, would you trust a consumer to read your X-ray? Well, that's a big issue, right? That's you have a life and death situation. So we are very uncomfortable with that. But what's happening now is that for every 100 X-rays, about maybe 1 or 2%, maybe 1 or 2 is peer reviewed by somebody else, right? So maybe 1 or 2 X-rays today peer reviewed by another radiologist. Okay, so 2 things could happen. There is that number one, computers can peer review 100% of X-rays, right? Because the incremental cost is very low, and therefore, when that happens, they can bring out they can bring back an X-ray to the radiologist and say, "Did you look at this area?" Okay. Also, another thing the computers can do, they can when a radiologist is reviewing an X-ray, they can point out a few areas maybe he should spend some time looking at, which is basically like assisted driving, almost like coming back to self-driving, right? So today, my Tesla car helps me to drive. It doesn't drive for me, but it provides assisted driving. And I think this is what's most likely lies in the future for next probably at least 10 years. And that's why that is really not a risk for Uber for a long, long time. So this is a very long answer to your question. But, when you write a 37-page paper, it's very difficult to answer these questions in the short one.
Well, the thing that I liked about both of the write-ups was the depth that you went into, and also the thing that I liked, especially about the Tesla one, was the discussion about moving away from ICE vehicles or internal combustion engines and towards the electronic. And I really enjoyed that analogy of what happened to the horse and buggy makers when cars kind of became the thing. And I thought that was really a brilliant insight, and it really kind of made the evolution from normal air quote normal cars to electric cars that much more, I guess, stark to me, and I really enjoyed that. And I guess one of the things about Tesla that we talked about before was the aspect of their valuation now and what they're going to have to do to get to that. And you were talking about how they still have to bend metal to make the cars, and people focus so much on the fact that it's a technology company, but I think it's really more than that. I think Uber probably falls into that category a little bit too, don't they? Maybe not. maybe thinking that through a little bit. Maybe that's not a great analogy.
No. Actually, kind of interesting. I think that's a good. There is a reason actually. So there is a reason why, like, if you own Uber, right? Because Uber can literally grow its revenues tenfold and their incremental investments in infrastructure are going to be minimal, right? Just because it's really kind of a software connecting by, kind of two-sided network. It's like eBay, right? It's almost like eBay considers, connecting, buyers and sellers. It's kind of the same thing, right? If you think about the core income, kind of core businesses is growing, right? With Tesla is this. I'm very proud of the analogy I used. I call it Tesla's valuation basically assumes there is a temporal wormhole developed, because well, because like in the Star Trek, I remember I'm a fan of Star Trek. I remember when like a starship can go from one galaxy to another, and if it wasn't for wormhole, it would take 100 light years or whatever. But because of wormhole, it can get there in seconds, right? Well, like Tesla today is, I think, manufacturing roughly about 500,000 cars a year. And like if you look at Toyota, and this is not a perfect analogy, by the way, but if you look at Toyota, I think it's making it close to maybe 8 to 10 million cars a year. And Tesla has a larger market capitalization than Toyota by 30%. So the market is basically assuming that like the future already has happened, right? And Tesla is manufacturing, like almost 10 million cars a year. Well, the problem is there are two things with that. So there is a time, and there is a time element of that, right? It would take time to Tesla to get from 500,000 cars to 10 million cars, right? But also it takes a huge amount of capital. So to get to the 500,000 cars a year production, Tesla spent, I forget, either $25 or $30 billion in capital expenditures. Just imagine that, $25 to $30 billion. So in other words, if you're saying, just think about it, right? So if you're saying the production will go up 10 or 20 fold, just think of, they would have to spend hundreds of billions of dollars. Okay. And that's real money. So, and that capital is, that costs money. There is they're going to have to build factories, bend metal, etc., all these different things, right? So that's a real cost. And basically the market is completely ignoring this. And let me make another kind of tangential point. That is actually also true. The temporal wormhole is happening to a whole bunch of other companies, today that are, I'm not even talking about the FANGs, actually. I'm talking about you have a lot of technology companies that are trading at, 30, 40 times revenues. They're not even trading on earnings anymore because they have no earnings, right? Like to me, company that trades at 5,000 times earnings or 5 million times earnings kind of falls in the same category. Like there is no difference between them. So that's why this company trades on revenues, 30, 40 times revenues. And, they're kind of investors as kind of assuming that, there's a temporal wormhole there as well. Like but the same thing happened in 1999, by the way. So, we kind of seen this movie before with a lot of these companies and Tesla as well, So I just took, we never had a position on Tesla until recently. We have a small position in put options in Tesla, but that's, then again, it's really just, because of the valuation. It doesn't mean that Tesla is not an important company. I absolutely love my Model 3, but, it just, the stock got ahead of itself by a lot.
Yes. Yeah, the last 3 or 4 months of all the craziness in the stock market is you've seen so many crazy things, like Tesla, like what's the truck company, Nikola?
Nikola, which is a play on Nikola Tesla. So I think
yeah, exactly. It's too bad he isn't better known.
I think you should tweet Elon Musk and tell him he's the temporal wormhole. I bet you he would retweet you.
Yeah, well, he would like it actually, right? Because
Yeah, exactly.
It's very space sexy. Yeah, that's a good
Yeah.
point. He would probably get a chuckle out of this because it is, and he would. And here's the interesting part: he probably would not disagree with me that much. Like,
Yeah.
I think he commented on the stock price, saying that's kind of, it got itself ahead of itself.
Yeah, that was funny too.
Mm-hmm. Where, for those 2 or 3 people out there that are not familiar with you, where can people go to find more of your work?
Got it. So I'm going to give you 2 different locations, one for readers and one for listeners. How's that? So you can read my articles and subscribe to my emails on the contrarianedge.com, edge.com, contrarianedge.com. However, those who'd like to strain their ears instead of their eyes, we have a kind of a lazy man's podcast, which is basically my articles read to you by a professional, artist. And you can go to investor.fm, like an FM radio. If you go to investor.fm, you can just listen to. We only have unlike you guys, we only have 84. I think we have 84 episodes. So you guys are much further along than us. But you can listen to my articles basically in a just audio form.
Yeah, they're awesome, and I will say this, that Vitaliy's writing is some of the best out there, and if you have not checked out any of his stuff, you absolutely must. He is a fantastic thinker, as we just illustrated here in the last hour or so that we spoke, and I've learned so much from his writing, not only his Contrarian Edge blog, but also the books that he's written as well. And the podcast is a nice little bonus treat, because then I can read it first and then I can listen to it later, so it can help reinforce what I already read. So I appreciate the opportunity to have that stuff. And we, of course, appreciate Vitaliy taking the time out of his busy day to come talk to us. We really appreciate that.
Thank you, guys. It was a pleasure. Thank you.
All right, folks. So that's going to wrap up our discussion today with Vitaliy. Again, we want to thank him very much for taking his time out of his day to come talk to us. It was a pleasure to speak with him again, and great insights into everything from markets to Uber to Tesla and beyond. So thank you again, Vitaliy, for your time, and go out there and invest with a margin of safety, emphasis on the safety. Have a great week, y'all, and we'll talk to you guys next week.
We hope you enjoyed this content. 7 Steps to Understanding the Stock Market shows you precisely how to break down the numbers in an engaging and readable way with real-life examples. Get access today at stockmarketpdf.com. Until next time, have a prosperous day. The information contained is for general information and educational purposes only. It is not intended for a substitute for legal, commercial, and/or financial advice from a licensed professional. Review our full disclaimer at einvestingforbeginners.com.
Thank you for listening. This and other investment articles by Vitaliy Katsenelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaliy's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.